Avoid these beginner crypto mistakes. Welcome to the exciting world of cryptocurrency. Whether you're curious about Bitcoin, intrigued by altcoins, or looking to explore new financial opportunities, this space offers limitless potential. However, for beginners, it often comes with its fair share of challenges. Many newcomers make costly mistakes that could be easily avoided with the right guidance. In this video, we'll walk you through the most common beginner crypto mistakes and share practical advice to help you stay safe, make informed decisions, and start smart. By the end of this video, you'll have the foundational knowledge you need to navigate the crypto world with confidence. Let's dive in with the first mistake many beginners make. The golden rule of cryptocurrency investing is simple. Always do your own research. DIOR. One of the biggest mistakes beginners make is blindly following trends or trusting every piece of advice they see online. It's so easy to get caught up in the hype, whether it's a new meme coin promising overnight riches or a recommendation from an influencer promoting a hot investment opportunity. But here's the truth. Not all cryptocurrencies are created equal, and not all advice is trustworthy. Proper research is critical. So how do you start? First, dig deeper into any project you consider investing in. Ask yourself, what is the purpose of this project? Does it solve a real-world problem, or is it just riding on hype? Who are the creators or developers? Are they experienced professionals with a track record of building successful ventures? Or are their identities hidden, sending up a potential red flag? Does the project have a white paper? This is a document that outlines the project's goals, technology, and vision. A missing or vague white paper is a warning sign. Next, familiarize yourself with the term tokenomics. This refers to the economic design of the cryptocurrency. Study the total supply of tokens, how they are distributed, and whether the supply is capped or unlimited. Projects that issue infinite tokens may suffer from inflation, devaluing their worth over time. Finally, be skeptical of promises that sound too good to be true. Scammers often use tactics like guaranteed returns or exclusive opportunities to lure in unsuspecting beginners. Stick to reliable sources of information like reputable news outlets, official project websites, and platforms that promote transparency. Remember, your best bet is to invest in knowledge before investing in cryptocurrency. Imagine diving into a swimming pool without planning how deep the water is or whether you can swim. It's risky and reckless. The same applies to cryptocurrency investing. Many beginners jump into the market without a clear plan, leading to financial losses and unnecessary stress. A solid plan begins with understanding your own goals. Are you looking to hold cryptocurrency long-term, believing in its future utility and growth? Or are you interested in short-term trading to take advantage of market volatility? Your strategy will largely depend on what you aim to accomplish. Next, allocate your budget wisely. Never invest money you can't afford to lose. Crypto markets are volatile, with prices frequently swinging high and low within hours. Having a clearly defined budget keeps your emotions in check and prevents overexposure to risk. It's also important to diversify your portfolio. Instead of putting all your funds into one coin, consider spreading them across multiple projects. A well-thought-out diversification strategy minimizes the impact of a single project's failure on your overall investment. Finally, take time to educate yourself on basic trading strategies and how the market works. Avoid making decisions based on gut feelings or emotions. Instead, develop discipline, stick to your plan, and adjust as you gain experience and understanding. Cryptocurrency offers freedom and decentralization, but with great freedom comes great responsibility. Unlike traditional financial systems, crypto is mostly self-managed. If you're not careful, poor security practices can result in losing your entire investment. One of the most common mistakes beginners make is leaving their crypto on exchange wallets. While exchanges are a convenient place to buy and sell cryptocurrencies, they're also prime targets for hackers. In crypto, the phrase, "not your keys, not your coins," highlights an important truth. If you don't control the private keys to your wallet, you don't truly own your assets. A safer solution is to use a hardware wallet, a physical device designed to store your private keys offline. These wallets significantly reduce the risk of hacking. If hardware wallets feel costly or unnecessary for smaller investments, consider using trusted software wallets that maintain robust security protocols. Additionally, enable two-factor authentication, 2FA, on all your accounts. This extra layer of security makes it harder for unauthorized users to access your account, even if they have your password. Make sure you use strong, unique passwords for every platform, and never share them with anyone. Backing up your wallet is another essential step. Losing the private keys to your wallet means losing access to your crypto forever. Securely store backups in multiple locations, such as an encrypted USB or a fireproof safe. Ultimately, securing your cryptocurrency investments requires vigilance and proactive measures. Don't underestimate the importance of protecting your digital assets. One of the most tempting mistakes for beginners is overinvesting in cryptocurrency. It's easy to get caught up in excitement and throw more money into the market than you can afford, especially when prices are climbing. But the first rule of smart investing is, never invest more than you're willing to lose. Cryptocurrency markets are inherently unpredictable. Prices can rise and fall dramatically in a matter of hours. Although this volatility creates opportunities, it also introduces significant risks. Beginners often enter the market expecting quick profits, only to panic and sell during sudden dips, locking in their losses. To mitigate these risks, start with a small investment. Think of it as a way to get familiar with how the market behaves without risking too much. As you become more confident and knowledgeable, you can increase your exposure gradually. Diversification is another key principle. Don't put all your money into a single cryptocurrency. For example, if you're interested in Bitcoin, also consider diversifying into top-performing altcoins like Ethereum or other reputable projects. Diversification spreads risk and avoids over-reliance on one asset. Finally, be disciplined during market highs. It's easy to fall into FOMO, fear of missing out during a bull run, where investing at overpriced levels could backfire when prices correct. Staying rational and sticking to your pre-planned budget is critical to long-term success. The psychological aspect of investing is often underestimated, but it plays a crucial role in decision-making. Many beginners fall prey to two major emotional pitfalls: FOMO, fear of missing out, and panic selling. FOMO typically happens during a major price surge. Watching others boast about tripling their investments can tempt you into making impulsive decisions, like buying at the peak price. Unfortunately, jumping into an inflated market often results in losses when prices inevitably correct. Tackling FOMO requires patience and a reminder that there are always opportunities in the crypto world. You don't need to chase every trend. On the flip side, panic selling occurs during market dips or crashes. Seeing your portfolio lose value can be nerve-wracking, but remember, crypto markets have historically rebounded from downturns. Holding on to fundamentally sound investments might save you from locking in losses. Developing emotional discipline means sticking to your plan, trusting your research, and avoiding the noise of social media. Learn to view market fluctuations as natural cycles rather than crises. Finally, let's end with some practical tips to help you set off on the right track. Start small. Treat your initial investments as a learning experience. By starting with small amounts, you can explore different facets of the market with minimal financial risk. Choose beginner-friendly platforms. Use reputable exchanges and wallets with simplified interfaces designed for new users. Binance, Coinbase, and Kraken are some beginner-friendly examples. Engage with the crypto community. Join online forums or communities like Reddit, Telegram, or Discord, where you can ask questions and learn from others' experiences. However, always cross-check advice. It's easy to encounter misinformation. Set a timeline for learning. Crypto is a vast field with new concepts like DeFi, NFTs, and blockchain applications emerging every day. Outline a timeline for learning about advanced topics after mastering the basics. Above all, approach cryptocurrency with curiosity and caution. The more informed you are, the better your decisions will be. To recap, the path to success in cryptocurrency starts with avoiding common beginner mistakes. These include failing to conduct proper research, investing without a clear plan, ignoring robust security practices, overinvesting or failing to budget appropriately, letting emotions dictate your decisions. Cryptocurrency is a truly transformative technology that promises both opportunity and financial freedom. While the learning curve may seem steep, staying disciplined, informed, and cautious will help you navigate it effectively. Ready to get started? Hit that like button and join the conversation by sharing your thoughts or questions below. Don't forget to subscribe for more guides and insights into the exciting world of cryptocurrency. Stay safe and happy investing.